an expert CRA Secrets podcast where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets, defer capital gains tax, eliminate the need for the 1031 exchange so you can create and preserve more wealth, or help your clients, friends, and family do the same. My name is Brett Swartz. In each and every episode, I'm joined by some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He's out of the great state of Pennsylvania, and since 2005, he's been a full-time real estate investor. And in that time, he has successfully completed projects involving dozens of fix and flips, office buildings, single-family homes, and apartment buildings. He commands thousands of multifamily units in partnership with millions in passive investor equity, and it's earned him recognition as a trusted authority, regular contributor, and podcast guest on Bigger Pockets. And he has an active YouTube channel as well as a best-selling book, Raising Private Capital: How to Build Your Real Estate Empire with Other People's Money, and so much more. Please welcome to the show with me, Matt Faircloth. Matt, how are we doing?
I'm great, Brett. Thanks for having me today.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, man, no problem. Let's see, 2003, I was dating lovely Liz Randazzi, who has been Elizabeth Faircloth for the last 18 years. But her and I were dating, and she put the little purple book, so to speak, in my hand of Rich Dad Poor Dad. And that really changed my life, changed my trajectory. I was a traveling sales rep for a equipment sales company called Ingersoll Rand in 2003, and did well, as most folks that work sales jobs or corporate or whatever do, Brett, like they do well enough, right? It's like well enough to not quit, right? And that's where I was, but I wanted more out of my life, I knew there was more in me than that, but just wasn't sure what it was. And so after reading that book, I was really tuned in I was really tuned into what was possible for myself, and what I could get myself into with regards to real estate investing. So
there we go. So it should be better there.
Yeah, you sound amazing now, and now your video has changed. And so, Matt, we're talking with Matt Faircloth. By the way, you can go to droastergroup.com, and he all about passive, hands-off real estate investing. Oh, Matt, you sound like 100% better now. Matt, sorry, you go again.
Sorry, brother. Yeah, I'll start. I'll take to it. Right. So she put the little purple book in my hand of Rich Dad Poor Dad, and that opened up all kinds of realms of possibilities for myself with regards to investing and everything like that. Fast forward to today, I run a company where I focus mostly on marketing and capital raising and sales, and I've got awesome partners that run our acquisitions department that help us acquire new deals, that help us, get into new markets. And that also I've got another partner that runs our ops. And so we are vertically integrated. We control, as you said, thousands of units of multifamily assets. We also run a fund. We are also looking at other asset classes, including hotels, anything that's just a great asset of sticks and bricks that produces, as Kiyosaki talks about in his book, cash flow. We are primarily a cash flow based investment company. If the deal produces cash flow day one, we begin to get excited about it, and we will likely pursue it.
Fantastic. And we're talking with Matt Faircloth, by the way, passive hands-off real estate investments, droastergroup.com if you want to learn more. So Matt, let's talk just about that, right? Before we got on the show, you were mentioning different real estate investments, right? They're hands-off that maybe people don't always think about, right? So talk to us just a little bit about the secret to hands-off, right? Meaning that you don't have to do anything, that or in the sense that you can invest with a group like you guys. Yeah. But what kind of investments can people go into?
Yeah, there's a lot. So at the end of the day, Brett, you know what it is, and I talk about this in my book, in Raising Private Capital, which you're kind enough to mention as well, in that there are two energies, let's say, in investing. That is the effort and the money. In my book, I call them the deal provider and then the cash provider. The deal provider is the one that is finding and managing the deal. and the cash provider is the one that's putting the real dollars and cents into the deal. And sometimes that's the same person. So if I were to go out and buy a duplex myself and find the asset, find the market first, find the market, then find the investment, then negotiate it to closing, then operate it well, either manage it myself or deal with a property management company, whatever it is. I'm injecting my own time into that investment. I'm also putting my own dollars into it. Through passive investing, what you're able to do is you're able to separate time and money. And your money goes in to a deal as a passive investor. And my wife and I have hundreds of thousands of dollars in passive investments with our own company and with other operators as well. And we enjoy that mailbox money that comes in from the passive investments that we make, because we're not having to put in the time to move that investment forward. And then there's other folks, and that's where the DeRosa Group, my company, would come in, or other operators that come in and they put in the time to find the investments that you're going to be investing in, to negotiate that deal to closing, and to manage the deal to success. So that's really what passive investing is really putting your money into something where there is another individual or another company's time that gets put into making sure that the investment that you made gets brought to success.
Yep, very well said. I love the way you put it, and I can tell you wrote a book on it because you articulate that
Yeah.
beautifully, right? And so the effort and the money, right? The deal provider and the equity provider, and sometimes it's both. And really, you're trying to get equitable. I just read a book with the great late Sam Zell,
Mm.
and it's Am I Being Too Subtle? Amazing book, by the way. Everyone should read this book. It's so good. It's one of the top 5 I think I've ever read. It's so great. He talks about a equitable amount of exchange, right? Like equitable effort, expertise, time, or money for an equitable amount of return. So he didn't talk about fair. He talked about equitable, right? So talk about how the Roaster Group and how you guys are making it equitable for just exactly what you're talking about, time and money and expertise and all of those things to make a win-win for the passive investor.
Well, it depends on how you slice it, right? There are other operators out there that are gonna, fee and carve out their deal up and down the street to, to make sure that they're protected and whatnot. What we do is we tend to do like a win-win arrangement with our investors, where we tend to not win very much at all until the investor starts winning. Like our fund that we run, there are no fees. It's only profit share. And as the investor starts to win in cash flow and profit, then our company starts to succeed. For apartment building deals or whatever it is, it's typically the same way, where there's maybe a minor acquisition fee that gets taken when the property closes. But then beyond that, the majority of the money that we make is in cash flow share alongside investors. And in that, so that's really the way you structure a win-win. That's what I would say if I was a passive investor seeking, as I am a passive investor myself as well. When I'm looking for investments to get myself into, what I look for is that win-win, where the operator of the deal doesn't really, they can't outsize their wins before I, as the investor, start to see real success as well. And so it's in that hybrid marriage, even like waterfall structures, where the more profitable the investors get, the more money the operator gets. That's fine, because that means the investors achieved over a certain hurdle rate, and more money goes to the operator who's driving that success. They're creating those returns for the investors. So of course the operator should make more and more. So I love structures like that. I hate heavy fee structures, Brett, but I love win-win things like waterfalls and carve outs and profit shares going to the operator that's creating those profits for me as the investor.
Absolutely. I love the way you put that. And I like that concept of the win-win, right? And basically cash flowing success on both sides, right? And not feeling like it's outsized. So let's shift into one of the funds that you have. It sounds like it's a lending fund, and tell us a little bit more about that, what that looks like, and what you're lending to, who you're lending to, and what kind of returns there are.
Well, what's interesting, the reason I started this fund is that, and I talk about it in my book, is that when I first got started, I was borrowing, money from investors, onesie, twosie. I would borrow some money and do a fix and flip, or borrow some money and do the BRRRR strategy, where you buy a property, renovate it, rent it out, refinance, repeat. And I would use investor capital, typically their self-directed IRA, because that is the best vehicle to put into a private loan. We can circle back to that if you like. But we would take those self-directed IRAs and put it into short-term private loans and the investor would put, let's say, for example, 100K into a deal, and I would make them 10K through interest on the deal and everything like that. And then they would make their 10K back. And then they had 110K tax deferred through their IRA vehicle. And they could take the 110 and put it into the next thing that I had, and then recycle it over and over and over and over again. And before you knew it, they have a much larger snowball that they were pushing up the hill, right? Different in cash, which is where things like DSTs get involved with cash investors and things like that. It's a different tax consequence and different conversation that comes into it. But that IRA investor, when they invest in a multifamily syndication, I looked at it and I said, I'd love to find a way to help these folks, make short-term gains on their money so that they can recycle it over and over and over again, as you would through an IRA vehicle, and that, which is hard to do in a syndication. So that's why we designed the fund, which allows people to compound their returns, which you can't do in a syndication. And it's also liquid, so people can get their money back whenever they want. So that's what I really love about the fund that we created, because I took a lot of what I'd learned in running small onesie twosie deals, and I said, okay, how do I 10x this? And so now we run a multi-million-dollar fund that allows people to do just that, and the money just goes into short-term bridge deals, a la AKA hard money. And it's just a 3 to 6 month turnaround, and the money comes in and out, and as long as you're able to keep your finger on the pulse for the money, investors can make a great return, and they can also enjoy the benefits of compounding their money as we grow.
Absolutely. I love that. But I feel like it's a great hybrid with stock market or even T-bills or stuff where people want some liquidity. So let's talk about some of the stats. So let's start with what's the average LTV on each deal? Are these first positions versus second positions? Are they personally guaranteeing the loans? What's the average interest rate return? If I raise my hand, how quickly can I get the capital out? Just give me some stats. I put $1 million in tomorrow. What's the cash flow? Is it per month? Is it quarterly? Kind of break it down there.
Sure. And so it's one of those things where it's a way lower minimum. You want to put $1 million in, no problem, Brett. I'll give you my phone number at the end of this, no problem. I'm kidding, but it is 50K minimum, so it's a low minimum bar for investors. And there is a let's see, LTV. The highest LTV I have is 60% LTV of total project cost. And so sometimes you'll go in. A lot of times these bridge deals will go in on deals where it's like you're acquiring for a certain number, and then you were doing a certain amount of renovations. Typical hard money deals, like we will do, will lend a part of that construction and a part of the purchase price of the property or the current value of the property. We just like to see some skin from the borrower, some of their own cash into the game, whether that comes on the acquisition side or on the construction side. So that's number one. It's almost always a first position lien. Of the dozen loans we have, one of them is not in first position, it's in second, and we're still sitting at 40% LTV in second position. So if we're going to go to seconds, it's likely an even lower LTV hurdle that we like to see. We charge the operator 12%. And we do a profit share with our investors above the pref that we have of 8%. So there's a hurdle of 8% that all the money goes to the investors. Anything above that, we split that above the 8%. We split that with investors 50-50. But again, like I said, no fees. The points are that the borrower does pay points, but those go to an originator that found the deal. That's all the money they make is the person that finds and closes that loan. They make an origination fee. So that's a win for them as well. And we get us and our investors get all the interest on the loan. So that's what's great about it.
Okay, cool. So it sounds like it's about 8 to 10% or 8 to 12%. With the split. Maybe let's call it 10, because if it's at 12, the origination, there's no fees that goes to the originator, and you guys are loaning mostly first positions, 60% LTVs. Is that a fair summary so far, Matt?
Yeah, it is. And what's different than many of the other hard money loan funds that are out there, there's plenty of hard money funds that provide a great sense of security. You can compound the returns, but those funds typically pay a flat rate of 6 to 8%. What I like about what we've done is if we can negotiate a better interest rate with a borrower, our investors win. They get a percentage of the upside. They're not making just a flat pref on their money. They're making the pref and then some, which in this deal is the pref of 8 plus a share of the profit of the upside. So that's what I really like about it.
Yeah, that's great. And then you mentioned liquidity. So how quickly, if someone wants to get out, like, hey, I got a nice deal, Matt, I want to go buy now. How quickly, if they raise their hand?
Yeah. So we may lift this in the future, but currently there's a 1-year lock. And so the money's in for a year. And that makes sense because you got to find a deal. You got to get the money working. That's typically 2 deal cycles that we can do in 1 year. But if the investor wants to move on to the next venture, they can give us notice, and we have up to 90 days to give them their money back. We can give it to them in less than that if we want. And the reason why that is so the money could be tied up in a deal, but we have deals that are paying off, on a regular basis. So we should, we should be able to have that money come back way inside of 90 days. We give ourselves just a conservative runway to be able to pay the investor back in 90 days or less when they ask for it.
Yeah. Okay. Got it. So it's a 1-year lockup and then a 90-day. It could be less after that 1 year. That's awesome. We're talking with Matt Faircloth, DeRosaGroup.com. So, Matt, what are you seeing right now? Right. So deal wise, right? The fourth quarter. Now we're in the first quarter of last year. Are you sensing that sellers are starting to meet where the market really is, at least for deals that make sense for cash flow? Talk to us a little bit about what your sense is on where we're at with this buyer's market
stuff, Brett. So not just on let's moving away from the hard money fund, because that's a whole different animal, right? My company primarily owns multifamily. We invented the hard money fund as a hedge to the multifamily investments that we have, so that investors, when they join us, can have a couple of different flavors of ice cream, so to speak, right? So it's not like, what do you want, multifamily or multifamily? This is what we have. But while we wait for multifamily to come back around, and we believe that it is, beginning the answer to your question, we have other things we can offer, including a hard money fund where people can be, liquid when they want it, right? Now, on the multifamily fund or multifamily market, what I'm seeing is, I believe that we're going to see some interesting stuff in Q1 and Q2. I had a great call with one of the top 5 bridge lenders in the U.S. That has originated a lot of the bridge loans. I was talking to one of their loan officers, and he said, we're currently talking a lot of workouts and restructure with our owners. This was in Q4. He said, he predicted, he said in Q1, we're going to start taking ownership, meaning like they're going to start pushing investors and owners to hand back the keys and that. So I think that although a lot of folks that are watching the market and are hoping that the Fed saying that they're going to start dropping rates maybe turns into fruition and maybe drops the things like the SOFR and the 5 and 10-year Treasury to the point where that investors can refi out of their deals or sell their deals at lower cap rates. I don't know if I see cap rates. I've seen cap rates go up, so to speak, like for sure. They've gone on deals that were 4.5%. I'm now seeing 5.5%, 6%, even 6.5% cap rates or higher in certain markets. And I don't think that's going to come back down because I'm not one to believe that we're going to go back to the way things were just a few years ago. I don't see rates going back down to 2, 3, even 4%. I think that we're going to need to learn to deal with a interest rate environment in the 4.5% to 6.5% range. I think that's what it is. And there are operators that built their business plan around rates staying at 3.5 to 4. And I think that those are folks that are going to have to either do capital calls or maybe do a sale that's a little bit less than what they wanted to get for it. And then there's going to be, I do believe, Brett, there's going to be deals that are going to be sold at or below what is owed on the properties. But I am not a doom and gloom, blood in the street predictor. I do think that there will certainly be deals to be had, but these are not going to be open market deals that are going to be had. These are going to be deals for folks that are plugged in to markets, not the operator that's in. Like if somebody listening here is an operator, and if you're surfing like 10, 15 markets, the best thing you can do to take advantage of what I think to be real opportunities showing up is to focus on 1, maybe 2 markets. That's what we tell our students in multifamily, is that you really ought to focus on a really minute handful of markets. And that's the way you get plugged in to the opportunities that are going to come up, because they're not going to be mass marketed opportunities. These are going to be, for example, Brett, a broker going to an operator they know can close on an opportunity and say, hey, I have a great opportunity for you, but you need to close it in 30 days, no questions asked, and you're going to get it at 20% off of what you think it's probably worth. But you got to be able to get in and jump. So that's what I think is going to happen. Again, my crystal ball is broken, but that's what I believe will be select opportunities in the new market.
Got it. Yeah, I'm talking with Matt Faircloth, DeRosaGroup.com, DeRosaGroup.com. Matt, let's shift a little bit into 1031 exchanges, right? And or the biggest frustration when it comes to a 1031 exchange and capital gains tax. I imagine there might be clients or investors or people that you work with that
Yeah.
are selling that business, want to sell that crypto, want to sell that real estate property, and
Yeah.
want to be into like your passive, hands off real estate lending fund or multifamily deal, right? But the timing's not quite there yet, but they could sell and they have this big capital gains tax. So talk about the frustration as it pertains to, the 45 180 or not being able to go into real estate funds. What would that mean if there was a solution that could solve for that?
Well, I see a lot of tons of frustrations, Brett, around the 1031. As you know, it's like one of these things that gets thrown around a lot. It's one of those solutions that is easier said than done, so to speak. And I've had friends in the business that have wanted to do 1031s, but it really ties your hands in a lot of different ways, man. I mean, like there's a lot of hurdles that are there to that you've got to get over, and then the IRS is not so flexible on time. They're not going to give you 180 days, no problem. We'll give you a little bit more time to find another deal. And as I just got finished saying, the market that we're in is somewhat tumultuous, and to have a limited amount of time to place that capital into a deal, you may end up having to settle or force a square peg into a round hole, which is why other options outside of the 1031 are definitely paramount. And one more reason why 1031s are cautionary, as a syndicator, if I'm selling an asset, it is again possible, but very, very difficult to do a 1031 with a large group of investors. Again, like I said, you can do it, but you can also take 45 cats and herd them into a tractor trailer all at once, right? Which is kind of what you have to do when you have to convince all 45 of your investors that the next thing is a good thing for them to invest in with you, or to roll their hard-earned their principal into the next deal. Which is why I think that vehicles like a DST are a great alternative to a 1031. Not that a 1031 is bad, it's just difficult, and it can be complex, difficult, and not very rigid. In my experience, I've done a few 1031s and I found them to be just that.
Yeah, I can agree with you more. In fact, we call it the shotgun wedding, right? You're getting engaged in 45, married in 180, and or
Yeah.
the blockbuster, you got to return it within 3 days, right? Versus the flexibility
Yeah.
of having something like the deferred sales trust, which
Yeah.
allows you to not only exit those assets, but then get time back on your side, right? And diversification back on your side to wait to a deal until a deal comes up and to diversify into multiple assets at different timing and not have to feel like you have to do it all yourself. And it's also what it called the seamless partnership separation. That's a good point you bring up there. We just had a $13 million exit in San Diego. It was 4 partners. Guess what? One was ready to retire, just pay his tax. He's gone. The other 3 wanted to diversify and be out of debt and wait for the market to shift. And so about 2 years ago now, we sold the 13 million, paid off 4 million of debt. The rest of it went into the trust, each individual trust, and they've been investing passively with groups like yourself, Matt. Like this is what they do. Like the point is, you can do it now. You just have to know how to do it. In fact, if you want to learn more about that, you can go to capitalgainstaxsolutions.com. You can start to build your capital gains tax exit plan. Make sure you're not just building the wealth; you're building the plan to execute when you do exit the wealth, so you're not caught in a tough position. Matt, any thoughts on that?
Yeah, well, that's really what gives diversification. And we've had a few investors approach us that are in vehicles like that, and they're very happy, and I think that like just life isn't rigid, and investing is not rigid, and so to have that level of flexibility allows you to just have some time to think. I mean, honestly, people think, 45 days, it's plenty of time to identify. I can't tell you, Brett, how many brokers I've had call me, and you could just hear over the phone. You could hear the sweat beads on their forehead, scrambling, looking for a deal for their client that's in the middle of a 1031. They're trying to find somewhere to land, and it's almost like, hey, do you have anything you could sell? Anything you got? These guys are looking for anything they could put the capital in. Brett, I don't want to invest that way. If I were the operator, if I were the 1031 participant, I would be very upset if I'm running around saying like, anything you can, I'll take whatever you got. I mean, like the 1031s really corner you, but a DST does not. It gives you that much more versatility and the ability to, like you said, you want to sit on the sidelines and wait for the market to slow down a little bit. You can do that. like as you said, you want to have one partner exit, one person retire. They don't all have to ride on the train. That you can have exits on the highway, so to speak. That's why I think it's a great vehicle.
Thank you so much. Yeah, people want to learn more, again, go to capitalgainstaxsolutions.com, or the best for the best 1031 exit plan, go to experttaxsecrets.com. That being said, Mr. Matt, are you ready for the lightning round?
Ooh, I'm in. Let's do it.
All right. Knowing what
Good
you know
luck,
now,
everybody.
yeah. If you know what you know now, if you go back to your 25-year-old self, what's the one golden nugget? Make sure to tell yourself to do.
Make sure you marry her. No, I'm kidding. But I would tell my 25-year-old self, all joking aside, to stay focused. I spent too much time in my early entrepreneurship career, Brett, in trying different things. I was the investor that was in the middle of like 3 wholesales and 2 fix and flips and a couple of rental deals and buying an office building, right? I like legit, those are real things that were happening, not just making it up. And so if I had to do it over again, I would have picked a thing, and for me at the time was rentals. And that's been the key to my wealth and my success. But to pick one of those things and really go all in on it. So that's what I'll tell my 25-year-old self.
Excellent. What's the number one book you've recommended or gifted the most in the past year?
The past year. I've gotten really into health these days and longevity and unlocking the code of human longevity. Like, Brett, why does some people live to 100 and some people live to 60, right? And so there's a book by Peter Attia that it's on the tip of my tongue. I believe it's called Lifespan or in that, but Peter Attia is a phenomenal author. And so any of his books would be phenomenal for people to check out. I know you might've said business book, but that's just a book about the human condition.
Excellent. Question number 3, what are you most curious about right now?
I'm curious about, I sure do wish I had a crystal ball, Brett. Like I'm curious about where the next 2 years are going to go with us as an investment world, as a country. I feel like there's a lot of things happening and just what's going to change over the next couple of years. So that's probably something. I think that there's a lot that's going to change, and I'd love to know what it's going to be, but I'm curious about everything from like how AI is changing our world to everything else, from American politics to the American financial system and the stock market and all those things. Where do we go from here? I just cannot. I'd love to be a participant in it, and I love the spot that we're in. Curious where it's going to go.
I couldn't agree with you more.
Yeah.
Last question. After all your success, helping all the people you've helped, what do you do to practice to stay centered in your values and stay encouraged to charge forward to reach even higher heights?
I read my goals daily, and my goals are centered around my values. And so I review these things on a daily basis. I plan my week. I'm very intentionally in planning my actions. So that's how I stay centered. You could make a plan for the year and then cross your fingers and hope that it comes true. But it's even better to make that plan intentionally and then revisit it as often as you can and make sure that you're on track with it. So that's something I do to stay in touch with it.
Amazing. Matt, I want to thank you for being on the show. I want to thank you for sharing your wisdom with us today. I want to encourage you to keep using your gifts and talents to help people create and preserve more wealth with multifamily investing, with passive hands-off real estate lending funds. For our listeners who want to get in touch with you, would you remind them one last time, what's the best place for them to find you?
Sure. Best place is my company's website right there behind me, derosagroup.com, DEROSA group.com. They can get a copy of my book. They can hear about the passive investments that we have. And we also have an education platform that teaches people how to become an A+ level multifamily operator as we are. And that's called the DeRosa Accelerator program, which they can join at that website as well.
Amazing. Thank you, Matt. I also want to thank our listeners for listening to an episode of the Capital Gains Tax Solutions podcast. We're also streaming on Expert CRE Secrets podcast as well on YouTube channels. Please feel free to subscribe and find us there. We want to remind you that the enemy is not having a good, clear plan. Matt just talked about having a clear plan for his goals and for his values and sticking to those and reviewing them. So having a clear plan for your exit plan is also so important so that you don't, pay 25 to 50% of your gains or all the way to the tax man, right? Have a clear plan and options available. That's why we want to encourage you to go to capitalgainstaxsolutions.com, check out our book, Building a Capital Gains Tax Exit Plan, and also check out our brand new Best 1031 Exit Plan. It's a 1031 service with the alternative with the deferred sales trust as a backup plan, all packaged into one. So you never have to work with a QI company that doesn't either know or doesn't cooperate with your goals, which are typically not to pay the tax, which be able to defer the tax and have a backup plan. So go to experttaxseekers.com for that. Appreciate everyone watching out there or listening on the